Hello everyone and welcome to the Rosecut market update for August. I'm pleased to say that we've had a bit of a market rally in the last few weeks, so stock markets have actually gone up for a bit this year. It's been nice to see, but we're not confident it's going to last, are we, Mike?
I don't think so. So the rally is likely a typical bear market rally, which is historically, if you look in bear markets, you do get these sharp upward rallies. Some of it based on short covering, i.e. closing out of kind of more pessimistic or negative positions. Earnings haven't been that bad either, I have to say. Volumes in the last couple of weeks have been very, very low, which is not terribly convincing. And I think the issue behind all of this is whether the Federal Reserve is finished with its aggressive interest rate tightening, and the same for the other central banks, and whether some of the other risks to the world economy are going to dissipate. And inflation is still very high. I think there's a big reputational and policy risk to the Fed from stopping its aggressive rhetoric and the pace of rate increases. We have the Jackson Hole Monetary Policy Conference next week, which will tell us more. And I think also the fact of this rally is a bit of a red flag to the Fed, in that it shows that animal spirits are still quite strong and they need to drain liquidity. And I think, Daniel, it's very technical, but the quantitative tightening program from the Fed is one of the things to watch coming up.
Yeah, absolutely. The quantitative tightening, as it's called, is the inverse of the quantitative easing that we heard so much about after the 2008 crisis. And what it essentially means is that the Federal Reserve is no longer going to be going into the market to buy government bonds to help support those prices. By supporting those prices, what they did was reduce the yield on those bonds, and that therefore made it easier for companies to borrow money and invest. So that is coming to an end. Quantitative tightening officially started in June, but it's not being done at scale, not yet. It starts in September, when we have, I think it's $95 billion worth of quantitative tightening every month. And what that means is they won't be buying bonds. So they're not selling them, they're letting them mature and roll off that way. But it essentially means that there's a big buyer in the market that's no longer going to be buying. So in 2018, when they tried this, it led to a bit of a market sell-off then. I think we had a very quick 20% drop towards the end of that year. And as a result, it's one of those reasons why we're cautious. But just going back to some of the points you mentioned there, Mike, short covering, I think that's a really important one to focus on in the short term. For those that aren't aware, it means that lots of investors, such as hedge funds, were betting on stock prices going down. And when the market starts going up and they're on the wrong side of that trade, they often have risk managers that come over and say, look, you're exceeding your risk limits, you've got to close out that position. And that's what short covering means. It means that they now have to buy back those stocks that they were short. The other point I'd pick up on is when you mentioned about central bank credibility. We've seen reviews of the central bank's mandate taking place in Australia, and we've even had talk of the Bank of England having a review of its mandate. And Andrew Bailey, who heads up the Bank of England, has said he's open to such a thing. So you can see there's some political pressure coming on central banks to make sure they act. So we have quantitative tightening for them to show they're more credible. We've got the Jackson Hole event that you referenced. I think the next interest rate decision in the US is the end of September, and the market currently expects 50 basis points at least. That, like you say, makes it look like it's a bear market rally. I'm trying to think of what other catalysts we could be missing, Mike.
I think the positioning in the market is actually quite complacent at the moment. Volatility is low. Many of the tactical indicators are quite stretched to the upside. So in a sense, the catalyst can be a small thing. It can be a speech or a number of speeches from central bankers to, if you like, correct the misperception in markets that the Fed is going to ease off. I think also looking at the energy complex and looking at inflation, despite signs of slowing growth in Asia, despite all the best efforts of the US government in particular to reduce the level of the oil price, it's still pretty sticky around this sort of $90 level. and could actually squeeze higher. And I think if we get an energy price crisis into the end of the year, that will actually push up headline inflation numbers. And they're also very, very high across Europe. So there's plenty of stress factors in the system. And I think given where positioning is, it just takes a small change in view to produce more volatility. I think also we'd probably see a further run to treasuries. The dollar can strengthen as well. So I think our view for the next couple of months is to be cautious, not to make big bets, and maybe take risk off the table.
Yeah, that's well summarised. I mean, we still remain heavily invested in cash. So we have 20 to 25% held back. So that's providing a significant safety net against volatility. We do have some equity exposure still, so we have participated in this upside move to the markets, but just lagged a little bit. So this is how defensive positioning obviously plays out. You don't get all the upside because you're trying to protect against downside fall. And as you say, we'll probably rebalance, keep those portfolios in line with our intended weights. But overall, the message remains the same. Stay cautious, keep money aside for market sell-off, and that's when we'll be able to strike to benefit from lower prices, hopefully.
Exactly, that's a good summary, I think.
Excellent. Well, thank you, Mike. I look forward to talking again next month.
Yeah, thanks. Exciting time ahead, I think.